Would you like to pay £30 million worth more of tax upon an investigation from HMRC? Probably not. But if you get some tax advice that leads to an investigation, that leads to 30 million because you're transferring property from one group structure to another, then be careful. Check out this video as we go through the gory details. Hi everyone, my name is Simon Mishevich, and in this video we're going to be talking about HMRC and how they prevented the benefit of a group tax relief for stamp duty land tax. Now, typically, just give you some perspective of this, we're talking about using holding companies whereby you move a property from an investment company up to your holding company or to another special purpose vehicle within the holding company structure, and there should be no stamp duty land tax charge as a result of that transfer. However, HMRC went against this, and quite understandably, given the case that I'm going to share with you today. So when we talk about holding company structures, make sure you do get some tax advice, because we are going to be blatantly sharing with you when you get tax advice that goes wrong, you pay the tax, not the company that's providing you with the tax advice. So really, it's important for you to understand that. So let's just go through this particular case. And this is the Tower 1 St. George Wharf Limited versus HMRC. Okay. This is something of a cautionary tale, which it really is, because we know that you should be able to move properties between your companies with a whole structure and no SPV. So why did it all go wrong? In a group of companies entered into a scheme intended to achieve a substantial corporate tax saving. And I'll talk about that in a second. Not only did the scheme fail to achieve the hoped for advantage, but the group ended up with an SDLT charge of 8 million. So greediness will cost you more tax than you thought. And now let me just talk about this. Let's imagine that you are a property developing company. You bought a property for 100,000. You have done it up and it's worth, for let's say another 50,000, and it's now worth 200,000. Now, if you move that property, because it has to be based on market value when you transfer it from one company to another. Okay, that's really important to know. Now, when you've done that, you've got a £50,000 profit in the SPV when it's moving that asset out of the way. As a result, that £50,000 would be subject to corporation tax. So that's really a big tax liability that you're looking at there. So I'm just moving my microphone so it's a bit closer. As a result of that, what did this company do? The group wanted to transfer, the second paragraph now, the group wanted to transfer a residential tower block, which it was developing into an SPV for purposes, SPV, special purpose vehicle, which the tribunal accepted was entirely commercial. So you're doing the property up, you're minimizing your risk from the SPV, moving it to another investment company. That's absolutely fine. That's commercial. That's fine. The transfer was made via a series of transactions, leases, and all the rest of this, trying to be really clever, but failed. Intended to step up the tax basis of the development, so the SPV would be treated as acquiring its market value without any tax liability arising along the way, which is just blatantly wrong. They should never have tried that. Anyway, they did, and it failed. The tribunal upheld stamp duty land tax charge on the final transfer of the development to the SPV on the basis that group relief was not available because the transfer was part of a scheme. So not only have they really messed up the corporation tax, which I believe was 30 million of the property that they tried to transfer it from to the other company, but they messed up the stepped up basis of 170 million. So, missing out on that huge amount of corporation tax. Not only did HMRC say, well, I'm not interested in your scheme, I'm actually going for the stamp duty land tax because you did a series of transactions. Huge amount of tax liability, as you could probably appreciate. There is a tax court case, which if you want to have a look at this, feel free to do so. Just do Google search you're looking for this particular thing. Tribunal Judge Christopher Staker between the Tower 1 St George and Rolfe Limited and the Commissioner for Her Majesty Revenue and Customs. And this was April 2022, so not long ago. And interestingly enough, we had a client that left trying to do this very same scheme. So good luck with that. Got to be honest with you. So again, what they try to do is manipulate the market value of the property to avoid corporation tax. As a result, we advise that you can get the SDLT, but you have to pay corporation tax. They didn't like that, went to another accountant and suggested the same thing. Only a couple of weeks ago did I find this out, and now the court case has come out to say that will go for us. So like I say, good luck if you're watching this video. So this is just the details of the case. I'm going to read this a little bit more because I think it's really, this is the summarized version of the court case. So there are some options there for you. But it says case proceedings, facts of the case. There was a bona fide commercial reasons. We know this. Transferring the property from one company, SPV, to another. Absolutely fine. And it even says ring fence risks and potential liabilities. That's not a problem at all. However, the second chunk of data here, these steps included a grant by the group company that legally owned Tower SGSL of a 999-year lease to another group of companies, B64, at book value, not market value, book value, and this is where they really went wrong, which significantly less than market value, the 30 million versus the 200 million, which ownership of B64 itself and from another group company to the appellant following a transfer of the lease, B64 to the appellant at book value. So again, missing out the whole 170 million growth. The appellant recognised that the intended corporation tax benefit in its company tax return, but following an HMRC inquiry into that, the appellant accepted that there was no benefit was available. So they got found out and they put their hands up straight away. And you kind of think, well, okay, fine, I've got hit with this corporation tax. Is that the end of it? Well, clearly not. Because we know that the Finance Act 2003, Schedule 7, Part 1, does allow you for this group relief. But because, again, it says here, group relief is not available if the transaction, A, is not effective for bona fide commercial reasons, which it was, or B, forms part of an arrangement of which the main purpose or one of the main purposes is the avoidance of liability tax. So straight away, they failed on the manipulation of the book value, and it's something that you really do need to be careful of. There's some other information I'm just going to go over. So another company that talks about this very case. I'm going to ignore some of the things here, but these guys talk about this section here. However, the group's tax advisors came up with it seemed like a good idea at the time. Don't they always? Sounds great, doesn't it? With FOMO, fear of missing out. Oh, my friend down the road is doing this. Yeah, it doesn't always work out, does it? They don't tell you all the bad things that happen. They devise a complex indirect. Now, as soon as a tax advisor tells you this really complex scenario, you should be thinking, oh, I'm really going to make some money. No, you should be thinking, this sounds really a bit dodgy and too good to be true. But we all get greedy, and that's the way it goes, isn't it? So tax-free uplift from the base cost of property from 30 million to 700 million. Bear in mind, corporation tax is at 19%. That's the difference that they're going to be paying. 19% on 170 million that they tried to get away with, right? They didn't get away with it. Plus, they got 8 million as well in SDLT. So there you go, guys. Get some good tax advice whenever you're doing group structures, holding companies, etc. Before you do anything at all. Make sure that you read the legislation that backs up what they've said as well. That's something that we do on our tax consultations. We always have a meeting, but we back it up with legislation references. So hopefully that's giving you some thoughts of what not to do and what you should do instead. Until the next video, my name is Simon Mishevich from Optimize Accountants. I'll see you again soon. Hopefully that video was useful for you, but please do not stop there. There are plenty of videos that I know that will help you build your wealth whilst reducing your tax liability. And in this video, well, this is the one I think you should be watching right now.